Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. Today, we're really digging deep into what's happening right at the core of the tech world. We're going to break down the latest Q2 2025 earnings call from, well, a true technology titan, International Business Machines Corporation, known to most of us, of course, as IBM.
hmm
And this isn't just about sifting through, financial statements or checking off numbers. No, this is about uncovering the fundamental forces that are actively shaping the entire technology landscape right now.
Right.
How major businesses are navigating and adapting to these, well, seismic shifts, and what all of this ultimately means for the future of innovation and sustainable growth across industries.
That's precisely it. Our mission today is pretty clear.
Yeah.
We aim to extract the most important insights and, crucially, those surprising facts directly from this earnings call. We want to provide you, our listener, with a concise yet incredibly thorough understanding of the intricate dynamics at play, where enterprise technology, the explosive growth of artificial intelligence, and broader global economic currents all converge.
hmm
Think of this as your essential shortcut to being truly well-informed on some of the most critical and, well, transformative trends unfolding right now.
And when we talk about the big picture, the headline here is compelling. IBM delivered some remarkably strong results across its key financial metrics. They actually exceeded their own expectations.
Yeah, quite significantly.
Right, and a significant portion of that success was driven by the stellar performance of their software and infrastructure divisions. What this quarter profoundly revealed, I think, is that in a climate where other sectors might be pulling back, technology investment, especially in areas like software and infrastructure, isn't just a line item anymore.
No, definitely not.
It's become the first line of defense for businesses seeking resilience, efficiency, and growth. IBM's performance here suggests a fundamental reprioritization of tech spend across industries, even in unpredictable times.
Indeed, it highlights a crucial shift. Technology isn't merely a cost center anymore. It's now seen as an indispensable strategic investment that's delivering clear, measurable dividends.
So let's unpack this by first diving into the macro picture and the strategic foundation IBM is building upon. One of the most striking takeaways from the call for me was the CEO's distinct shift in sentiment regarding the global macro environment.
Ah, yes, the optimism.
Exactly. He's gone from saying he was cautiously optimistic to just plain optimistic. That's a pretty big shift in mindset, isn't it? What's driving that kind of confidence?
It's a profound shift, and it's rooted in very specific observable trends across various geographies. If we look around the globe, there are concrete reasons for this newfound confidence.
Okay, like where?
We'll take Japan, for instance. For some listeners, the term reindustrializing might conjure images of, old factories. But what we're witnessing is something far more modern. A nation actively engaged in digital reindustrialization and, crucially, digitizing at unprecedented rates.
Digital reindustrialization. Okay.
This isn't just a gradual evolution. It's a rapid embrace of advanced technology to address challenges like an aging workforce and drive their economic resurgence, essentially modernizing their entire industrial base through technology.
So it's about a national commitment to leveraging tech for fundamental economic restructuring, not just like incremental improvements. That's quite powerful.
Precisely. And then consider South Asia. With countries like India, their economies are absolutely booming.
Right.
When you look at reported GDP growth of perhaps 6% to 7%, combined with an inflation rate of around 6%, what you actually get is a real-term economic expansion in the range of 10% to 12%.
Wow, that's huge.
It is. This substantial real growth means profits are being channeled back into highly diversified, tech-heavy economies, creating a virtuous cycle of investment, innovation, and expansion, particularly into a young, tech-savvy population.
That's a huge amount of capital being reinvested. What about the Middle East? We often hear about their diversification efforts.
Exactly. Nations like Saudi Arabia and the UAE are not just talking about diversifying. They are actively plowing immense profits back into their economies to build entirely new ventures, moving beyond oil.
Mhm.
And in nearly all of these new ventures, whether it's smart cities, new tourism industries, or advanced manufacturing, technology isn't just a component. It's playing an absolutely crucial foundational role. It's the very infrastructure upon which these new diversified economies are being built.
And Europe, which has certainly faced its share of economic headwinds, how does it fit into this optimistic outlook?
Europe has actually displayed remarkable resilience as a technology consumer, which might surprise some.
Yeah, a little.
But when you delve into their underlying concerns, issues around securing their supply chains, the ever-present threat of sophisticated cybersecurity attacks, and the undeniable challenges posed by their changing labor demographics, technology offers clear, compelling solutions to all of these headwinds.
Okay.
It's not just about efficiency, it's about strategic resilience and maintaining economic stability in a complex world. They're investing in tech to solve, frankly, existential challenges.
That makes perfect sense. Technology isn't a luxury. It's a strategic imperative for navigating modern global complexities. And here in North America, what's the driver?
In North America, companies are increasingly convinced, almost universally, that technology is no longer just a tool for optimization. It's now seen as fundamental for scaling revenue without the commensurate need for excessive capital expenditure or, an explosion in labor costs.
Right, doing more with less.
Exactly. Businesses are looking to technology to grow smartly, efficiently, and sustainably. They want to do more with less, and tech is the answer. The overarching takeaway from all these regional observations is crystal clear. Enterprise technology is poised for continued strong growth, with projections suggesting a consistent 5% to 7% range going forward, reinforcing IBM's optimism.
So what does this all mean for IBM? It's a very strong indicator that technology is not just a tool, but truly a fundamental competitive advantage. It's what allows businesses to scale operations without proportional cost increases, drive efficiencies in unprecedented ways, and consistently fuel growth. We saw this core belief really play out in the quarter's results.
What's fascinating here is how that belief translates into tangible outcomes, even amidst global complexities.
Yeah.
While geopolitical tensions were noted as not a major overall factor, they did cause some clients to proceed with a degree of caution,
Okay.
sometimes extending sales cycles or requiring more scrutiny for larger deals. And we saw some U.S. federal spending constraints in the first half of the year as budgets were prioritized. However, the company doesn't anticipate those to become long-term headwinds, because the underlying conviction in technology's role as a competitive advantage still shone through in the quarter's performance. For strategic, transformative investments, the spending continues, often at an accelerated pace as businesses seek stability and competitive edge.
This brings us perfectly to IBM's core strategy. Their laser focus on hybrid cloud and artificial intelligence. They see these two areas as central to everything they do.
Yes, and they've articulated this strategy through what they call a flywheel for growth, built on 5 reinforcing elements that feed into each other.
A flywheel. Okay.
First, there's an unwavering emphasis on client trust, which means fostering those long-term relationships and building a reputation for absolute reliability and delivering on promises. This is particularly crucial in enterprise tech, where decisions involve significant investment and operational impact.
So it's about building deep, lasting relationships based on proven reliability. What's the second element?
Second, they focus on flexible and open platforms, acknowledging the critical importance of interoperability across diverse cloud environments, whether that's public clouds like AWS or Azure or existing on-premise systems.
Right. Avoiding lock-in.
Precisely. This isn't about locking clients in. It's about enabling choice, seamless integration, and avoiding the dreaded vendor lock-in that so many enterprises fear. They want their solutions to work everywhere their clients do.
That adaptability is key for today's complex IT environments. And the third?
The third element is sustained innovation, meaning continuous and significant investment in research and development to ensure they remain at the forefront of technological advancement. This is where they're constantly pushing the boundaries in areas like AI, quantum, and advanced processors.
Okay.
Fourth is deep domain expertise, leveraging their extensive industry-specific knowledge to tailor solutions that genuinely meet the unique needs of different sectors, whether it's banking, healthcare, or retail. This isn't a one-size-fits-all approach. It's about understanding the nuances of each industry.
Like financial regulations, for instance.
Exactly. Knowing the regulatory landscape of a financial institution allows them to build highly compliant, secure solutions that a generalist might miss.
And finally, the fifth element that completes this flywheel.
The fifth is a broad ecosystem, which involves collaborating with a wide range of partners, from independent software vendors to global system integrators, to deliver comprehensive end-to-end solutions.
Right, partnerships.
Yeah. This allows them to extend their reach and offer more complete packages to clients, bringing specialized capabilities to the table that complement their core offerings. All five of these elements working in concert, like a well-oiled flywheel, are exactly what contributed to the quarter's strong performance, reinforcing their strategic direction and proving its efficacy in a dynamic market.
Building on that macro optimism, it's clear that IBM's software division is a powerful engine propelling much of this growth. Let's delve into why software showed such impressive momentum this quarter with an impressive 8% growth.
What's truly fascinating here is the sheer predictability and stability this growth represents. The company has built a high-value annual recurring revenue, or ARR, base that has now grown to $22.7 billion.
22.7 billion.
Yeah, that's up a solid 10% year over year. For our listeners, ARR signifies a stable, subscription-based revenue stream that's highly predictable, meaning IBM can forecast its future earnings with greater certainty.
Predictability is gold.
It really is. This stable base underpins their confidence that they are very well positioned to approach double-digit software revenue growth for the full year, making it a reliable pillar of their business.
And within software, Red Hat continues to be a standout. It delivered an impressive 14% growth, accelerating by 1 point sequentially.
Right.
That's truly remarkable, especially considering its scale.
It absolutely is. The drivers behind Red Hat's sustained success are multifold. They're seeing consistent double-digit bookings, indicating strong ongoing demand across their portfolio. There's high demand for hybrid cloud solutions, which is Red Hat's bread and butter, enabling clients to build and deploy applications once and run them anywhere on public clouds, private clouds, or their own data centers.
Right.
Critically, they're gaining market share across key solutions, with OpenShift revenue in particular growing over 20%. For those less familiar, OpenShift is Red Hat's leading enterprise Kubernetes platform for containerizing and managing applications across these hybrid environments. Its ARR alone is now a substantial $1.7 billion.
1.7 billion just from OpenShift. And this leads to something truly interesting, the significant opportunity arising from the virtualization market. What's happening there, and how is Red Hat positioned?
This is a crucial strategic play. The acquisition of VMware by Broadcom and the subsequent changes in Broadcom's pricing and go-to-market strategies are causing many enterprises to actively seek alternative solutions for their virtualization needs.
The Broadcom effect.
Exactly. It's created a moment of disruption in the market, and OpenShift is emerging as a leading common answer for both containerization and virtualization. It offers a unified platform that many enterprises are finding increasingly attractive as they navigate these shifts, looking for greater flexibility and cost efficiency.
So a two-for-one solution, almost.
Kind of. Instead of just running virtual machines, they can now use OpenShift to run both containers and virtual machines, giving them more agility and control. And beyond OpenShift, Red Hat Enterprise Linux, or RHEL, itself is seeing high single-digit growth, driven not just by standard server footprints, but also by an increasing demand for additional AI workloads running on the platform as AI adoption scales.
It seems like they're really capitalizing on market shifts, which is always smart. Another area of strong growth is automation, which grew 14%, and it sounds like the HashiCorp acquisition is off to a flying start.
The synergy here is incredibly powerful, maybe even exceeding initial expectations. HashiCorp's annual bookings have actually doubled under IBM's umbrella in just the first quarter since the acquisition.
Doubled already.
Yeah. And the projected pipeline for the second half of the year for the entire automation portfolio is a staggering 3 times what it was last year. This isn't just about combining two companies. It's about unlocking new customer value through an integrated value proposition that spans IBM, Red Hat, and HashiCorp.
Okay.
We're seeing specific, tangible benefits from joint product synergies, such as those between Red Hat Ansible Automation Platform, which streamlines IT operations, and HashiCorp Terraform, which automates infrastructure provisioning. It's like having a team that not only builds the house, but also automatically furnishes and manages all the utilities within it.
So it's more than just an acquisition. It's about creating a unified, more powerful offering that addresses major client pain points.
Exactly right. The company expects automation to accelerate even further throughout the year, well above their original model, potentially reaching mid to high teens growth.
Mid to high teens, wow.
This acceleration is fueled by the increasing complexity of client technology environments, which drives a critical need for high resilience, seamless operations, and crucially, lower labor costs. Automation becomes the answer to managing this complexity and achieving efficiency.
Makes sense.
A fantastic example of this is SAP's plan to deploy IBM's high-value automation portfolio, including Red Hat Ansible Automation Platform and HashiCorp Terraform and Vault,
Vault for security.
Right, Vault, which provides secrets management and data protection for complex systems. This really highlights the strategic importance and cross-portfolio power of these integrated solutions for even the largest global enterprises.
Let's shift to data, which saw 7% growth, largely fueled by their AI offerings. Clearly, generative AI is a huge part of their story.
It's a massive story, and the numbers are truly eye-opening. The company's generative AI book of business now stands at over $7.5 billion inception to date,
7.5 billion.
with momentum accelerating quarter over quarter. This book of business represents the total value of client engagements related to Gen AI, from strategy to deployment. There's strong demand across the board for AI agents and assistants, for their RAGL AI.
AI in the operating system.
Yeah, that's AI capabilities integrated directly into Red Hat Enterprise Linux, their flagship operating system, allowing AI workloads to run seamlessly on existing infrastructure, and for their Granite models, which are their own large language models designed for enterprise use. And crucially, there's an accelerating need for their consulting services to actually deploy this AI effectively.
Right, it's not just plug and play.
Exactly. It's not just about selling the technology. It's about helping clients implement it in a way that truly transforms their business.
They even got recognized by Gartner as an emerging leader in Gen AI consulting and implementation services.
Yeah.
That's quite an endorsement from a major analyst firm.
It truly is. What's brilliant here is their client zero experience. IBM isn't just selling AI tools, they're using them themselves to transform their own enterprise operations, embedding AI across more than 70 internal workflows.
Eating their own cooking, as they say.
Pretty much. This internal progress isn't just for internal benefit, it directly fuels and accelerates their client engagements. They can show clients with undeniable proof, look, we're doing this successfully in our own massive, complex business, and here are the tangible benefits.
Like what kind of benefits?
Well, they've seen increased productivity in HR, faster problem resolution in IT, and more efficient supply chain management. This resonates strongly. Companies like UPS, Verizon, Mizuho, and Nestle are already leveraging these IBM tools to unlock data, drive automation, and significantly reduce operational friction in their own businesses.
And they're not slowing down on the innovation front either, with recent acquisitions and new features unveiled at their Think conference.
Not at all. This quarter, they acquired DataStax, which adds real-time, scalable data capabilities essential for modern AI-driven applications. Think of it as providing the high-speed data pipelines and robust databases that generative AI needs to function effectively and make decisions in milliseconds.
Got it. High-speed data fuel for AI.
Exactly. And at their Think 2025 conference, they launched a suite of new features. First, Watson Orchestrate, which lets you build custom AI agents without coding, complete with over 150 pre-built domain-specific agents and partner integrations for the full agent lifecycle.
So easier agent creation.
Right. Imagine an AI assistant tailored specifically for HR or customer service, built quickly and easily. Then there's watsonx.data, enabling easier access to trusted unstructured data. Think of unlocking insights from documents, emails, and call transcripts. Unstructured data is key. Absolutely. And finally, Web Methods hybrid integration, simplifying workflows, APIs, and data connections across complex hybrid environments, making it easier for different systems to talk to each other. This all leads to an important question. What's the long-term projection for agentic AI?
What's fascinating here is the projection that agentic AI maturation, meaning AI systems that can act autonomously and coordinate with each other, will power over 1 billion new applications and massive code expansion. This is seen as driving a critical need for automation.
Exactly. It's not just about building AI models. It's about automating the infrastructure and processes around them to handle that exponential growth in applications and code. It's the only way to manage such complexity at scale.
Makes sense.
Now, one area that saw a different dynamic was transaction processing, where revenue declined 2% in the quarter and was flat in the first half, which was below the company's model.
Why did we see this dip in transaction processing when everything else seems to be on an upward trajectory?
This is a direct reflection of the Z17 hardware cycle, referring to their latest mainframe system, the IBM Z17. Clients, as a standard practice, prioritize their hardware spending at the very beginning of a new mainframe program.
Okay, hardware first.
Right. It's part of what's called the stack economic play, which is a critical, perhaps surprising insight into the mainframe's enduring power. It's not just about the initial hardware sale. It's about a decades-long strategic commitment from clients.
Right, the multiplier effect.
Exactly. where every hardware cycle acts as a predictable springboard for significantly larger, high-margin software and services revenue. The mainframe platform generates a 3x to 4x multiplier on software and services revenue over its entire cycle.
3 to 4 times.
Yeah. So while more Z17 capacity is being deployed now, leading to an initial focus on hardware investment, transaction processing software and services revenue is expected to return to low single-digit growth for the full year and, crucially, resume growth in the second half as it capitalizes on this multiplier effect.
So a predictable cycle, not a worry.
Exactly. It's a normal cyclical dynamic rather than a fundamental decline in demand. It's the ultimate sticky business model, ensuring long-term profitability far beyond the initial transaction.
That's a good clarification. Let's move to our third segment, infrastructure, which truly serves as the backbone of modern enterprise operations. This division had a fantastic quarter with 11% growth, hybrid infrastructure was up 19%, and IBM Z surged by an astounding 67%.
67%. The significance of the Z17 launch cannot be overstated. It powerfully reflects the enduring nature of the IBM Z platform. This isn't just about legacy technology. It's about a platform that continues to deliver unmatched reliability, scalability, security, and performance for the most mission-critical workloads in the world.
Banking, airlines.
Exactly. Think of major banking transactions, insurance claims, or airline reservations. What's truly fascinating here is how AI use cases are strongly resonating with clients on this platform. The Z17 features the new Telum Tevuo processor, which isn't just a new chip. It's the engine that lets IBM Z handle over 450 billion AI inference operations per day with millisecond latency.
450 billion per day.
Per day. What that means for a bank, for instance, is they can run sophisticated fraud detection or real-time customer service AI directly on their core transaction systems without having to move sensitive data or worry about latency.
Ah, so AI inside the transaction.
Precisely. It brings AI to the very heart of their most critical operations.
That's incredible AI happening inside the transactional system, eliminating lag in data movement. And there's more AI integration coming for Z, right?
The Spire Accelerator, which will be available in Q4, will enable watsonx Code Assistant for Z and watsonx Assistant for Z to run natively on Z17.
Okay, Code Assistant and Assistant for Z.
Yeah. For our listeners, watsonx Code Assistant for Z uses AI to help developers modernize and generate code for mainframe applications, while watsonx Assistant for Z helps integrate conversational AI. This truly embeds AI directly into the heart of mainframe operations, making development and interaction with these systems much more efficient.
And clients are sticking with Z.
Definitely. The continued investment is evident. Over 70% of IBM Z clients are expanding or maintaining their capacity, signifying deep ongoing commitment to the platform as a long-term strategic asset. Furthermore, new software innovations are being brought to IBM Z, including watsonx Code Assistant for Z, watsonx.data, Concert.
Concert for modernization.
Right. Concert is a new solution for mainframe modernization and HashiCorp Vault, demonstrating a holistic approach to modernization and enhanced capabilities for these vital systems.
Now, distributed infrastructure revenue was down 17%. What accounts for that, especially with the strong performance elsewhere in infrastructure?
That decline was primarily due to product cycle dynamics. The company recently announced Power 11 in July.
Ah, the new chip cycle again.
Exactly, which naturally impacts sales of the preceding generation as clients anticipate the new, more advanced system. Power 11 is positioned as the next-generation platform for performance, resiliency, and scalability, designed to support mission-critical, data-intensive workloads across various hybrid environments. Its announcement, including Rise with SAP on Power 11, a strategic cloud offering from SAP, signals a significant future opportunity as clients transition to the new, more powerful platform. It's a temporary dip as the market prepares for the next wave of innovation.
And looking ahead, they also hit a major milestone in quantum computing. That feels like something out of a science fiction novel, yet it's becoming very real.
Indeed. This quarter saw the monumental deployment of IBM Quantum System 2 in Japan, in partnership with Riken, a truly global milestone, as it's the first installation of such a system outside the United States.
First one outside the U.S.
Yeah. This unequivocally reinforces IBM's leadership in the cutting-edge field of quantum computing. While quantum is still early in its journey, these deployments are critical steps towards solving problems that are currently intractable for even the most powerful classical computers.
Like drug discovery.
It's exactly. Potentially revolutionizing fields from drug discovery and material science to complex financial modeling within the next decade. For instance, imagine discovering new materials with unheard-of properties or optimizing complex logistical problems in ways currently impossible. It's laying the foundational groundwork for breakthroughs that could redefine industries and represents a bold, long-term bet on the future of computation.
That's a truly fascinating glimpse into the future. Moving on to our fourth segment, consulting. This revenue line was flat, stabilizing in the first half of the year after some earlier choppiness.
Right. While consulting experienced a challenging pricing environment where clients are often pushing for lower costs, the backlog remains quite healthy. It's up 4% over last year, totaling $32 billion at spot rates,
32 billion backlog.
which is actually up over 8% when you count for currency fluctuations. Erosion rates, meaning the rate at which existing contracts are canceled or reduced, are stable, and the duration of contracts has actually decreased by 6 months compared to last year.
Shorter contracts. Is that good?
Yeah, it's generally seen as a positive indicator because it signifies higher revenue realization within a shorter time frame and overall better quality of engagements, meaning clients are moving faster on projects. Their trailing 12-month book-to-bill ratio, a key metric for consulting, stands strong at 1.14 times.
Okay, 1.14. Booking more than billing.
Exactly, meaning for every dollar of revenue recognized, they're booking $1.14 of new business.
But the call mentioned an 18% decline in signings for the quarter. How does that square with the healthy backlog and positive indicators?
That's a good question. That decline in signings was, as they put it, entirely driven by last year's large early renewals. As we know, such renewals are typically low to no revenue realization in the current period and can often involve margin compression because clients get better deals for early commitments.
Ah, so it's an artifact of timing.
Precisely. It's not a sign of weakness in new business momentum. Crucially, net new business penetration, that's new clients and new project wins, was up 13% year-over-year and up 7 points in the first half.
Okay, new business is up.
Right. This resulted in over 200 new clients acquired in the consulting business year-over-year. These are the green shoots that are fueling an accelerated backlog for the second half of the year, signaling positive momentum for future revenue rather than a slowdown. It's about quality and new growth, not just existing contract rollovers.
That's a key distinction. And how is generative AI specifically impacting the consulting business? Is it truly transformative or just another service line?
Oh, generative AI is profoundly transforming consulting, and it's far more than just another service line. The consulting generative AI book of business has now reached over $1 billion in the quarter alone.
$1 billion in one quarter.
Just in Q2, with Gen AI representing over $6 billion of the total backlog. That's 17% and growing substantially. And it accounts for over 20% of bookings.
Wow.
And this isn't just about volume, it's about the high value and profitability. For the very first time in Q2, Gen AI revenue surpassed 10% of total consulting revenue. And notably, it did so at over a 3-point margin differential compared to their traditional consulting work.
Higher margins on Gen AI work.
Exactly. This indicates these are truly high-value engagements, bringing premium profitability because they are complex, strategic, and in high demand.
So it's not just about volume, but also about the quality and profitability of the Gen AI engagements, making them a significant growth driver.
Absolutely. Engaging with clients early in architecting their AI strategies is establishing their consulting arm as a strategic partner of choice, not just a vendor. And through the first half of the year, they're seeing a greater share of Gen AI signings tied to net new projects, which again speaks to future growth rather than just converting existing clients.
Okay. And partnerships play a role too.
Definitely. Additionally, there's strong momentum in strategic partnerships with industry giants like SAP, Microsoft, AWS, and Palo Alto. These partnerships aren't just names on a slide. They involve joint go-to-market strategies, shared solutions, and a collaborative effort to solve complex client problems, all contributing to significant headroom for growth. So, while decision-making for discretionary projects remains somewhat delayed across the industry, the company is clearly seeing an improvement in strategic wins with new clients and expanding engagements with existing ones.
Now let's turn to the broader financial health and the future outlook in our fifth segment. Overall, they reported strong financial performance, which seems to echo the operational success we've discussed.
They certainly did. The operating gross profit margin expanded by a significant 230 basis points.
230 basis points.
Yeah, indicating improved efficiency in their core operations and service delivery. The adjusted EBITDA margin expanded by 200 basis points, leading to a healthy 16% adjusted EBITDA growth.
16% growth there.
Yeah. For our listeners, EBITDA is a key measure of a company's operating profitability before accounting for interest, taxes, Depreciation and amortization, essentially,
Mhm.
how well the business is performing at its core. Operating pre-tax margin also expanded by 110 basis points, which was ahead of their expectations.
Good margin expansion across the board.
Absolutely. And operating earnings per share, or EPS, grew by 15%. Given the strong performance, the company is actually raising its expectation for a full-year operating pre-tax margin expansion to about 1 point, up from their previous estimate of zero point 0.5 points, signaling increasing confidence in sustained profitability improvements.
And what about their free cash flow generation? That's always a critical metric for a company's financial flexibility.
They generated an impressive $4.8 billion of free cash flow in the first half of the year, which is up about $300 million year over year. This marks their highest first-half free cash flow margin in reported history,
Highest ever for H1.
which is quite a milestone. The largest driver of this impressive growth is their adjusted EBITDA, which is up a substantial $1 billion year over year, demonstrating how strong operational performance translates directly into cash generation.
Mm-hmm.
What's fascinating here is that despite some headwinds from working capital, primarily due to prudently protecting their supply chain amid global trade dynamics.
Holding more inventory, maybe.
Yeah, meaning they might hold a bit more inventory or pay suppliers a bit faster to ensure continuity and also foregone interest income from the HashiCorp acquisition due to the cash outlay. The company is still ahead of historical attainment levels for this point in the year.
That speaks to strong underlying financial discipline and resilience.
It absolutely does.
Yeah.
They ended the quarter with a robust $15.5 billion in cash, up $700 million from the end of 2024.
$15.5 billion in cash.
Yeah. This, coupled with a solid investment-grade balance sheet of $64.2 billion in debt, where over 75% of their receivables portfolio is investment-grade, meaning a very low risk of clients defaulting on payments, provides significant financial flexibility.
Mm-hmm.
They also returned $3.1 billion to shareholders in dividends in the first half, demonstrating their commitment to shareholder value. And notably, they're raising their free cash flow guidance to above $13.5 billion for 2025, which is a strong signal of future cash-generating power.
We've talked a lot about AI and new offerings, but the company also seems very focused on internal productivity initiatives, almost like they're their own best customer.
You've hit on a crucial point. Productivity initiatives are a key part of that flywheel for growth and, crucially, for margin expansion. They are laser-focused on driving efficiency and cost savings by leveraging technology and, critically, embedding AI into their own internal workflows. That's their client zero journey we discussed earlier.
Right, the client zero thing.
It's like they're eating their own cooking. For instance, they're using their own AI to automate IT support, streamline HR processes like onboarding, and optimize software development
Well,
cycles.
it's real-world use cases internally.
Exactly. This internal progress isn't just theory. It translates into tangible savings. They exited 2024 with an annual run rate savings of $3.5 billion from these initiatives, and they now believe they can achieve approximately $4.5 billion in annual run rate savings by the end of 2025.
$4.5 billion in savings. That's huge.
It is. This significant increase in expected savings fuels further investments back into the business and enhances their financial flexibility. They're also optimizing their supply chain, including shifting distributed infrastructure manufacturing to an industry-standard strategic partner to simplify processes and optimize cash conversion cycles, which frees up capital.
What's their current strategy regarding M&A? We saw the DataStax acquisition this quarter, but is it a major part of their growth story going forward?
M&A remains a crucial component of their strategy, designed to complement their organic innovation efforts and fill strategic gaps in their portfolio. The DataStax acquisition is a prime example of adding real-time, scalable data capabilities for AI-driven applications, which is a critical piece of the AI puzzle.
Right, bolting on key tech.
Exactly. What's interesting is their optimism about the current M&A environment. They believe that rational regulation will allow sensible M&A, meaning strategically sound acquisitions that enhance competition and benefit customers, to be approved within reasonable timeframes.
So they think deals can still get done.
It seems so. This suggests they see continued opportunities for strategic acquisitions that can accelerate their portfolio and market reach without facing undue regulatory hurdles.
Despite all these strong results and optimism, some might wonder why they aren't raising their overall revenue guidance more explicitly for the full year. It seems like they outperformed.
That's a fair and insightful question. It's important to remember that while they absolutely beat Q2 expectations across revenue, operating margin, profitability, and free cash flow, The average analyst estimates for IBM revenue have already been raised by over $1 billion since January.
Ah, so the market already moved up.
Pretty much. So the market has already factored in much of this positive momentum and is perhaps running ahead of the company's internal projections. They are confirming accelerating revenue growth of 5% plus for the full year, with software specifically approaching double digits. And they are comfortable with Q3 consensus estimates for revenue and profitability, which actually implies continued acceleration of organic growth. So while they're not explicitly raising the overall revenue guidance for the full year, they are, in effect, confirming a very strong
Yeah,
trajectory.
got it.
They've prudently acknowledged there's upside and conservatism built into their guidance,
Mm.
which is a very standard and sensible approach in a dynamic market,
Mm.
under promise and over deliver.
Let's dedicate this final segment to truly analyzing the AI revolution and its impact on spending. Specifically, how does that impressive $7.5 billion cumulative AI book of business impact customer spending across the non-AI parts of the company? Is it truly incremental, or is it cannibalizing other areas, effectively just shifting existing dollars around?
This is a critical distinction, isn't it? And it's not a simple yes or no answer. We need to break it down across the technology stack. First, at the semiconductors and infrastructure level, AI spend is, by and large, completely incremental.
Completely incremental.
Yeah. We're not seeing CPU rates decrease, and the total volume of servers isn't declining. New AI workloads demand new compute power. While there might be some minor pricing pressure on what are perceived as commodity items versus high innovation areas like specialized AI chips, the overall growth remains robust. So new AI workloads require new compute, adding to the existing infrastructure rather than replacing it.
So AI isn't replacing the need for foundational hardware. It's absolutely adding to it.
Exactly. Next, consider the enabling software layers, things like AI runtimes or data preparation tools. This spend is purely incremental. There's no cannibalization happening with alternate forms of technology in these specific areas because these tools are new necessities, specifically driven by AI adoption. They didn't exist in the same way before.
Okay, so new needs, new software.
Right. Where it gets interesting is when AI comes into existing software products like Aptio for IT financial management, HashiCorp, or Turbonomic for application resource management. Here, the AI integration isn't cannibalistic of the existing products themselves. Instead, AI makes those products better, more competitive, and helps them take market share from those who are unable to do that. This is fundamentally a market share play, where AI-enabled solutions gain a distinct edge over those without. It's about enhancement and competitive advantage rather than outright replacement.
So it's about enhancement and competitive advantage rather than outright replacement. What about consulting, where we've seen a huge Gen AI book of business? Is that just redirecting existing consulting spend?
In consulting, it's a big piece of the AI book of business, coming from clients redirecting their dollars towards AI consulting, shifting away from alternate forms of consulting. So while some traditional consulting might see a slight dip as budgets shift, the overall pool of consulting spend is growing, and AI is capturing a larger share of that growth.
Okay, so a shift within consulting spend.
Right. This highlights the importance of focusing on transformative projects, which include AI, but also involve working with strategic cloud partners like SAP, Oracle, and Palo Alto. These types of projects are more robust and less likely to be cannibalized because they represent core strategic shifts for the client, though it's acknowledged that some customer application development can shift towards AI-driven approaches, especially where AI can automate code generation.
So clients are actively shifting their investment priorities towards AI-driven initiatives. What's the underlying fundamental motivation for this?
The primary motivation is clear. Clients are prioritizing AI because they aim to significantly decrease both their internal and third-party labor expenses.
Cutting labor costs.
Exactly. AI is fundamentally seen as a way to make room for new software investments by achieving operational efficiencies and reducing human-led tasks. It's not just about spending more, it's about spending differently and more strategically, targeting areas for major cost savings and productivity gains.
It makes sense.
For instance, a major bank in Western Europe is strongly motivated to use AI to improve customer experience by automating interactions and enhancing internal risk profiles through better fraud detection. They see AI as a direct path to both growth and reduced exposure to financial crime.
And what about in the telecommunications sector? What problem is AI solving there?
A telecom company in the United States is deeply exploring software-defined backbones for high-throughput networks. The goal is to gain greater flexibility in how traffic is routed and to leverage advancements in standard servers and software more effectively to handle massive data volumes.
Okay, network optimization.
Right. They see AI as integral to optimizing these complex high-volume networks, predicting traffic patterns, and automatically rerouting to ensure optimal service and efficiency. It's about building a smarter, more resilient network infrastructure.
Finally, let's touch on the federal government's evolving IT priorities and their AI action plan. You mentioned this earlier, but how is IBM positioned here, especially with their long history of working with the public sector?
This is primarily focused on the federal and government segment, which is a major area for IBM. What we've observed is a distinct shift in administration priorities. Initially, in the first 6 months, the focus was heavily on cost cutting and simply making operations more efficient.
Right, just efficiency.
Yeah. However, the current shift is quite explicit. It's now about modernizing agencies through technology. The goal is to provide better citizen services, improve agency performance, and fundamentally reduce waste, rather than just simply cutting costs. It's a strategic investment for the future, not just a belt-tightening exercise.
That's a fundamental shift from just cutting to actively modernizing and investing for better services.
Precisely. The recent AI action plan from the government underscores their clear intent to use AI for these modernization and efficiency goals across various agencies, from defense to social services. High-level conversations with various agencies indicate a serious commitment to making progress in the coming months. The company feels very well positioned as a credible player in this space, largely due to its long-standing track record in delivering for the government on complex mission-critical projects that require deep security and reliability.
Sure, they have the history.
They do. The bigger question here is, how quickly can the federal government move from intent to large-scale AI deployment, given its typical procurement cycles and the sheer scale of its operations? It's a huge opportunity, but also a complex challenge.
That's a powerful thought to leave us with. So to sum up, we've seen broad economic optimism from IBM's perspective, reflecting a global environment ripe for technology investment. The company itself delivered a very strong performance, driven primarily by its laser focus on hybrid cloud and AI strategies, which are clearly paying dividends.
Clear dividends.
There's deep, continuous innovation happening across both their software and infrastructure portfolios, which are key pillars of their success and are evolving to meet future demands. And perhaps most significantly, we're witnessing the truly transformative impact of generative AI, not just as a new product line, but as a force reshaping customer spending and internal operations across all sectors of the business, proving itself to be an incremental and highly profitable driver of growth.
And we connect this to the bigger picture. The integration of AI directly into core transactional workloads, as we've seen with the Z17 mainframe, suggests a future where AI isn't just an add-on or a separate analytical layer.
Right.
It's becoming an intrinsic, always-on part of enterprise operations, embedded in the very fabric of how businesses run their most critical processes. This prompts us to consider, what will this mean for how organizations measure productivity and innovation in the years to come as AI becomes an inseparable, almost invisible component of every business process?
A fundamental redefinition.
There really is a fundamental redefinition of how work gets done.
Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.